Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host, and I'm glad to have you back. If you wouldn't mind doing so, if you haven't already done so, would you please subscribe to the podcast? It's on 30 different channels, Apple, iTunes, iHeartRadio, Stitcher, you name it, it's out there. And while you're out there on the net, go to globalinvestoragent.com and click on Learn More, particularly if you're an agent, because we obviously do a lot of work with consumers, helping them buy and sell their homes, but we also have a specialty in working with investors, and that's going to be more important as this economy continues to turn. So don't just worry about what you're going to do or worry about surviving. Focus on thriving. This is not the time to panic. It's the time to prepare. And you can learn how to do that by clicking on Learn More. If you're a consumer, grab one of your agents out there, because we're in half of the states, the Global Investor Agent team is, and they're all trained to help you and I not only buy and sell our own homes, but also to invest in real estate, which is really important. So anyway, without further ado, we got a great guest today, Craig from Colorado Springs, Colorado. And Craig, thank you very much for being on board here. We appreciate you taking your time to do this.
Thanks for having me, Gary.
Yep. Hey, if you wouldn't mind, fill us in a little bit about, how you got to where you are. And that includes, beautiful Colorado Springs, but also in terms of business, what was that path you took to arrive at this point in your life?
Well, I'm from Colorado Springs. I'm a native. I actually joined the United States Army when I was 17. I went to basic training between my junior and senior year of high school. I came back because my skills training was then, it was split option. It was supposed to be after that. And then I was going to go to college. It was my path to pay for college. They kept me in training too long, and I couldn't start my first semester. My father was a real estate agent, and he said, well, you got this free semester. Why don't you get a real estate license? And I did. And I got to tail around him when he was doing these massive commercial deals, and I got hooked. But I quickly realized I liked having closings that happened regular. So I eventually went off in the residential world on my own. And that was October of 95. I got licensed. So I've been in real estate a little over 27 years now. How I got into this assumption group that we have is simply because for all of my career as a realtor, I've been sitting in closings, helping VA buyers buy homes. And at one point in the closing, they discuss the assumability of the mortgage. And I'd always make the comment to my clients, eventually the rate climate's going to change and you're going to have an asset that nobody else is going to have. Well, that didn't really take place for 20 years, but this year it became very relevant. And so a partner and I basically about February, March, and April, we started having discussions about the change in the marketplace and decided to create assumption solutions to help people process assumable mortgage transactions.
Awesome. Well, what's interesting is the world of real estate has changed a lot since you and I first started. I started about 9 years before you, January 1986, buying my first property, and then I got my license, Realtors license, January 2002. But in the 80s, almost everything was assumable, and there was no qualification process. You just basically signed a piece of paper, So my first property was purchased partly because I assumed the owner's first mortgage, and then my first house that I bought after that, which would be my own private home. That home we bought with my college roommate, and we rented out the two additional bedrooms. It was 4-bedroom house, of course, and those two guys' rent pretty much paid our mortgage. We had actually 3 mortgages on the property, but eventually got married, bought my own house. That house I sold and let that buyer assume that mortgage too. Now, as everybody knows, that all started changing in the late 80s and early 90s. But I want to dispel some myths here. People think, well, you can't assume mortgages anymore. That's not necessarily true, is it, Craig?
No, there's there's no non-qualifying assumables in existence anymore. That was kind of the Wild West.
Yeah.
When those existed. When I first got licensed in the mid 90s, we'd see occasionally a few of those pop up. And truthfully, if we saw those pop up, we would run out the door to try and buy them ourselves. They were rapidly going away. So now all that we have in existence today is the qualifying assumable loan. And the only loans that fall under that category are VA loans, which are designed for veterans, FHA loans, and USDA loans, which are more of a rural product. So pretty much all of the non-qualifying assumable stuff has gone by the wayside. No conventionals there. There might be some private type financing out there you could do something like this on, but our focus on a company is really just working with the qualifying assumable stuff that has now become viable with the change in the rate market today. So,
absolutely. Well, let's break that down. Let's talk about. Let's start with FHA, then we can talk about VA. FHA is probably the most common. Most people are familiar with that acronym FHA, and what that means in terms of buying and selling homes. But let's talk about the FHA mortgages and what's the process for assuming a mortgage, and why would someone want to assume a mortgage anyways in today's market,
Okay, yeah. So FHA, anybody who is wanting to purchase a home can assume a loan as long as they're going to be an owner occupant. Actually, none of the programs can be assumed unless you're going to be an owner occupant of the property. The programs were set up to help owner occupants when they were created. So basically, you as a seller, let's say you bought your home in May of 2020. After the pandemic started, the feds artificially jogged down the interest rates, and mortgage rates were down below 3% in many cases. So you have this tremendous asset that when you go to market your home, I think can differentiate. It's one more additive to your property when you're selling. So you put it on the market, and a buyer can come in, and instead of getting new financing on the property when they purchase it, they can qualify to take over your loan. So what that means effectively, they have to, instead of going to a new mortgage broker, they have to provide all of the required things to the existing loan holder so that they can be reviewed on a credit basis to take over that loan. So let's say you've listed your home, I'm just going to use round numbers of $350,000, right? When you bought your home, and over the time, your existing loan that you have remaining is $300,000. You've got a gap, we call it the assumption gap, between the loan that exists and the purchase price of the home of about $50,000 there. We try to teach people to think of that as your down payment, right? And so you can come in, put that $50,000 down on that home, and take over that, 2.25%, 2.5%, 3% mortgage. And instead of getting a new loan at 6, 6.5, 7, whatever rates may be that day, and you can save hundreds of dollars a month. In addition, the term has gone down. Maybe it's just a couple of years, maybe it's longer, depending on the situation of what you're assuming. But there's a double benefit there. Interest is paid out, term has come down, and your payment is lower at the end of the day. So we see that as a very attractive thing to buyers that are still in this market.
Yeah, absolutely. If you think about it, guys, the market we're heading into now is the ideal time to look for an assumption, particularly with someone who bought the house, several years ago. I'm not saying back in the last recession timeframe. I mean, just in the most recent years, because interest rates now at the time of this recording is right around 7%. And there's some movement to try to get them to go back down again. But we've also got, the other side, mainly the Fed, saying, well, we think we may need another rate increase possibly too. So we don't know what's going to happen. But the bottom line is, if you have the credit and the credentials and you have the cash and you want to buy a home, instead of buying it outright where you get your own brand new mortgage at 7%, the potential's there to buy one where you assume that the current owner's mortgage. And it's not just that you get the low rate. Remember, they've already partially amortized the property and you benefit from that, which means, if you look at amortization on a 30-year loan, your first payment is almost all interest, very little principal. And as you go forward, gradually each payment is less and less interest, more and more principal. So your payments are going more towards the principal balance on an assumed mortgage than you would if you started from scratch. That is a huge benefit. Okay. So in any case, keep that in mind. So let's talk about VA now. It's similar, but has some interesting additional parameters to it, right?
Absolutely. VA is a program for veterans designed to support people who've served the country. Generally, when a person first uses their VA, it's one of the true zero down loan programs out there for a buyer. And when they go to qualify for a VA loan, they have to determine their eligibility, which eligibility is almost like a certain dollar amount, right? And in their marketplace and based on their service and all that kind of stuff. So they buy their home, they use X amount of eligibility. They've got that loan, and it's 2.25%. I actually went to a listing appointment last night where an individual did have this 2.25% interest rate. And he is needing to sell. And we talked about the assumability. And I said, the main thing that he needs to think about as a veteran, anybody can assume his loan. Any qualified buyer can assume his loan, veteran or non-veteran. A lot of people don't know that. But there's a caveat. If a veteran allows another veteran to assume that loan, they can do what's called an eligibility swap, meaning the seller, his eligibility that was tied up on that loan and that home is released 100% for him to go use his VA loan again on another property. And that new home buyer swaps his eligibility onto that loan, as well as taking over liability for our responsibility for the loan and the payments. Now, if a non-veteran comes in to assume that loan, the eligibility that the original borrower had remains with that loan and is tied up, right? Gotcha. So that may be all of their entitlement. It may only be a portion. It depends on the situation. And that can affect whether or not that veteran can reuse a VA loan on their next purchase. Will there be people who are okay with non-veterans assuming? We've seen that there are. We have seen scenarios where some veterans have just said, I don't care what it takes. I just have to get this home sold as fast as I can. We have seen scenarios where some people have said, I'm coming out with a large profit. I'm going to have a lot of money to take to that next home. So I'm okay. I'll just go get a conventional loan. And we've seen veterans who have said, absolutely, I only want to go veteran to veteran. I want to use my VA loan again in another scenario. So that is the biggest difference of the VA program versus the FHA and USDA. FHA and USDA are almost the same.
Yeah.
The other caveat in the VA loan, when you take out a VA loan, you have essentially like a funding fee. When an assumption happens, there is a 0.5 point funding fee, unless, of course, that assuming party is a disabled veteran, where that can be waived in the transaction. So, but once again, we just look at this as it's another opportunity for a seller of a property to leverage an asset they have when they're marketing the property. Because when we market properties as realtors, our job is to expose what the seller has to the marketplace to leverage it as best we can. And really, you're leveraging location, features, and condition and how they work with price. you're just adding the next piece, and that is the assumability of the mortgage. I like to tell people in all cases, when you have a property, let's say everything is identical to your neighbor's property. You've got the same bedrooms, the same square footage, the same bathrooms, the same overall condition. Apples to apples, they should be listed at the same price, or they should sell at the same speed or for the same price. But then you have one house that's got a VA or an FHA loan at 3%, and you've got another house that's got a conventional loan on it that's not assumable. Well, which one should go first or for more? Right. To me, it's the assumable property.
Yeah. Well, it's interesting. Well, actually, if you don't mind, a couple questions for clarity. So the eligibility, their entitlement, that's actually based on dollars, not numbers of properties, right? So a veteran could have eligibility up to $500,000, but if they bought a house that's for $200,000, does that mean he still have $300,000 in eligibility that they could use?
You know, it's not a fixed dollar, and being a realtor in this world, I know enough about loans to be dangerous. Now, our head processor who in Assumption Solutions, who process these and qualifies buyers and goes through the whole thing, she's actually my go-to lender in the real estate business that I have. And the way she describes it to me is it's kind of like a complicated worksheet when you're actually figuring out their entitlement that they've got. So yeah, I'm not going to say it's a number of properties or it's a fixed dollar amount, but it's something that she can dig into and look into a person's scenario. But yeah, I've seen people over the years that buy homes in every duty station that they go to. So yeah, it's a great way to be a sort of an automatic investor, I think, for military folks.
I just wanted to take a moment to say thank you for participating in the Massive Passive Cash Flow podcast. Also wanted to let you know that the book Global Investor Agent is officially out in print and in Kindle on Amazon. You can get it by clicking on the link right here. If you are an agent, definitely grab yourself a copy. This book, guys, was not just written by me. I also included 8 other investor agents from around the country. And I didn't just handpick them. I literally opened it up to the entire audience, and it was first come, first serve. So you're going to get feedback from brand new agents all the way up to top 25 team leaders, some on my team, some are not on my team, with valuable insight and instructions and guidance and actual checklists to follow to not just survive but thrive in this market. I know you're looking for that advantage, and this is it. By the way, if you are an investor, grab a copy for your agent. And for everybody, all profits from the sale of the book, Kindle and print, all go to the Healing House Foundation, 100%. Thank you for doing that too, guys. Let's get back to the show. Well, what we've seen is typical example. I learned this too because my family's, I come from a military family and also lived around military bases my whole life then. And the last place I lived at was Tidewater, Virginia, where you've got Norfolk Naval Base, you've got Langley Air Force Base, Fort Eustis Army Base, Camp. There's a little Camp Pendleton, believe it or not, Fort Story. There's even the Fleet Combat Training Center, just an amazing area. But what I learned as an investor myself and a realtor, that veterans would buy a property where they currently are in the current duty station. And then when they move and they get reassigned, they wouldn't sell the property, but they would refinance it with a conventional mortgage. They did free up their eligibility. And then when the new duty station, they had the full eligibility to buy the next property. And they just did that. Let's say they did their 20 years and they probably accumulated 5 or 6 properties. But you know what? You retire from the military at 40 years old with your military pension and you got 5 or 6 properties. That's a pretty darn nice life, So
I remember being on the other side of a table where a gal who was retiring from the Pentagon was doing exactly that. She was liquidating 10 or 12 properties that she had accumulated over her career and netting somewhere north of $3 million from what I gathered. Plus she was coming out with her pension. So it's a great opportunity.
Oh yeah, absolutely. I love the life. I've always benefited from it. And I never forget driving on base when I was in college. I went to school at Old Dominion University in Norfolk, Virginia, which is Tidewater. And my dad gave me his old car, which was a '73 Buick Skylark. So it was not a chick magnet kind of car. This was like an old jalopy old man's car, but it had the insignia on the front left bumper. So I would drive through, wearing a t-shirt and flip-flops and scraggly hair and a little bit of scruff. And those guys inevitably would still salute and would wave me through, because of the insignia on the front left bumper of the car. And turns out later on, I ended up working for the Navy as a contractor. Get this, tracking Soviet subs, and I can't say anything more than that because I'm still obligated to. I be honest with you guys, I actually couldn't tell you everything that I did, how it was associated. The guy next to me, we never even knew each other. I mean, we were in a room, inside of a building, inside of a fence, and I just did my thing. That was my thing. I did my role, and that I came in, did that, and I left, and that was all I knew. So if people kidnapped me, they weren't going to get much out of me anyways, but I got to become familiar with a lot of guys in all branches of military, and I never did serve myself. But so back to the subject. Oh, I do have another question, if you don't mind. So let's say a veteran owned property, with a VA mortgage, he or she lets that be assumed by a non-military person, so that does not free up that portion of the eligibility. But if the purchaser does eventually, refinance with a conventional mortgage, would that then free up the eligibility?
Yes, as long as that loan is in place, that eligibility is tied up. But if it's paid off, or if it is just for some reason refinanced or whatever, although, boy, it'd be tough for me to see somebody being able to justify a refinance of a 2.25% mortgage as long as you're 2 or 3 points above it. But it could happen. You never know. But yeah, that would free it up from there.
Yeah. Well, this is really good news, because I know for me personally, I'm actually looking at getting my own another property, personal property, not an investor. I mean, I'm doing the investing too, but for my own purposes, I spend time in Pennsylvania, Virginia, and Florida, and I'm thinking, well, I should just have a house in each place then. And now the way the market's going, it looks like there'll likely be some opportunities. And knowing that I knew I could assume a VA mortgage, I didn't know about FHA and USDA, but that opens up a whole world of possibilities, because I could go in with cash, pay the difference between the loan balance and the purchase price, and assume a really wonderful low interest rate mortgage that's already been partially amortized, not just paid down, but the amortization schedule is more advanced. So more of my payments go into principal right off the bat. And that is a huge benefit,
Now we do get a lot of questions about what you talked about there with the gap with regards to the ability to finance it. There is no guideline in any of the government entities that you can't finance that gap. The challenge we find is finding somebody to do that. I think that it's also going to be, if you do finance that gap, a metric in the evaluation of the servicer looking at that new buyer as to whether they still qualify to assume if they are taking on additional debt.
Okay.
I don't think there's a lot of lenders that are excited to become second mortgage holders in this climate, in this economy that we're in right now, being what happened to second lien holders in the 2008 cycle.
Yeah.
A lot of them got wiped out. But I have run into agents who have told me in their local market that they have local banks that, in deals that they have done, were willing to do secondary financing for that. I think another option that may grow potentially is owner carry financing, potentially. I have talked to some people who have thought about looking at sort of closer to hard money type financing. Once again, I don't think either of those is going to be the majority of situations when people assume. I think most assumptions will be done by people bringing that gap in cash. In my real estate business, I actually have resurrected clients who were hunting for homes when rates were still low, backed out of the hunt when rates rose because they are payment sensitive. They have homes to sell. So they're move up buyers, right?
Mm-hmm.
When they sell their properties, they're coming in some cases with a couple of $100,000. So I've resurrected them in my real estate business because they're payment sensitive. So they're only looking for these assumable type properties that fit in the property, that fit in the loan range that they're comfortable with, the payment amount and interest rate that they're looking for. So I'm not saying it's easy to find exactly what they're looking for, but it's growing. You know, right now in our company, the biggest thing we're focused on is really training agents in this space on what their clients have as an asset and how they should be leveraging it as agents and marketing it to the through the proper channels, so that people who have buyers just like me can find them and can get deals done and get more deals done. So, I mean, that's one of the main reasons I love being here with you today is we are trying to reach as many agents as we can to teach them what this is, then teach them how to be out there growing their business with this and how to be out there marketing this and finding it as a buyer's agent, marketing it as a seller's agent, and doing more deals effectively.
Yeah. Well, I tell you what, and I appreciate that too, because it's a lot of agents are not aware of this. You know, they're not aware of it. They probably have heard that VA can still be assumed, but someone don't even know that. But so back to what you were mentioning a moment ago. Yeah, I'm not a big fan of hard money. I did it one time just to go through the experience so I could teach it with people. But there is hard money is considered private money, but not all private money is hard money. There are private lenders. You know, a typical example is a successful surgeon who just doesn't have time to get involved directly with real estate. They don't have time to look at properties and things like that, but they can fund properties. They can fund real estate projects because they're secured by brick and mortar, albeit they are second mortgages. And ironically, the first property that I bought, the one I mentioned earlier in the program here, it was in Virginia Beach, Virginia, 478 Leslie Terrace. And so we assumed that person's VA mortgage. He was still active duty. He had a second that we refinanced through a local community bank. And what to this day, I love I'm not a foe of the big banks. I'm just a big fan of the small community banks because they generally are more flexible. They're more open. They look at the project versus just trying to fit you in a silo. You know, the big banks, they have, models that they follow and pro formas and different silos. Well, the small community banks do have silos, but they're more willing to look at the project and judge it based on its own merit. So we were two kids. We'd only been in the workforce a month after college, and we qualified jointly for a second mortgage. So it worked. And we used owner financing too for the remaining equity. There was still equity in property. We gave the owner, the guy in the Navy, a third mortgage, right? A third note, for the remaining equity. So we actually had all three. We assumed the VA mortgage, the first mortgage, refinanced the second with a local community bank, and then we gave him a owner finance and gave him a note for a third for the remaining equity. So we actually did all three at the same time. That was my first experience.
That sounds like the definition of a young real estate entrepreneur, doesn't it? Right? Like
crash course.
Finding every crash way you can to get the deal done.
Yeah, I was just got out of college, and my grandmother, bless her heart, and my grandfather had since passed away, but they had an E-bond that they bought for all the grandkids way back and before we were even born. I mean, in the 1930s or 40s or something, like for $100. So by the time I was getting out of college, it was worth, I think, $1,800. That was the extent of my assets. I had an old jalopy, the old Buick Skylark. That was my other asset, But it just goes to show you, you if you don't ask, you absolutely will not receive. So absolutely get out there, swing the bat and try. And if you're an agent, remember, none of these things get in the way of you earning commission. What it does is it gives you more credibility when you can speak this language to your clients and let them know what all the possibilities are, not just hey, you got to go to the bank, get a new mortgage. That may be most of the business, but there's this part that we're talking about here that's very viable. And I think we need to spread the word further because interest rates are up. And I think over time, it will continue to go up. To me, 3% is like the once in a lifetime thing. I mean, it hadn't been 3% since 1962, the year before I was born. So this is you're talking about a 50, 60-year cycle. And, you know, I don't know, I'm not saying rates won't go back down again for 60 years. That's not what I'm saying. I'm just saying the likelihood that is not very high. Most likely 7% is probably, I mean, in my opinion, that's still good. Because when I first started investing, heck, I was paying 9%. We thought
my first time I bought at 8. Yeah.
Yeah. You know, it's just amazing. So any I know we're getting close on time here, but anything that we could discuss, Craig, that we haven't discussed yet, or any words of wisdom for the agents or even the consumers who are listening to this, because I know everybody's, it's uncertainty. What am I going to do? How do I do this? You know, there's always a way. Where there's a will, there's a way. But any words of wisdom you could provide?
I think people should be aware of timelines, right? Mm-hmm. Your standard real estate transaction, you go under contract, is usually closed within 30 to 45 days. Mm-hmm. What we are telling people is when you enter into this contract, you may need to plan for a process that takes upwards of 60 to 90 days. Okay. Because our company, what we do is we gather everything from the seller and everything from the buyer, vet the buyer. We work directly with the servicers to get this approved. What we have found is the servicers are unprepared for this change themselves. And some of them are giving bad information, which we're kind of trying to warn them that they could be opening themselves up to legal liability. But some servicers are telling people that their loan isn't assumable when it absolutely is, because all these programs are. Some servicers are telling people that the seller can't make money at the sale, almost like they think it's a short sale, right? Which a seller absolutely can. And we're telling them that another thing they're doing is they're telling some people it could take 6 to 9 months. Well, VA and FHA actually have a handbook that discusses the timeline that this should take, or that is required for it to take. VA, the servicer is supposed to approve this no later than 30 days from the receiving the packet, and FHA, I believe, has a 45-day timeline for it to be approved. So we have something when we communicate with them that's kind of like, guys, if you don't follow these guidelines or if you do any of these things, you could be in trouble. But it's a new territory. It's very akin to the territory of 2008 when the short sale stuff came to light. None of the servicers were prepared to process short sales, but within a few months or years, they all had portals and systems. It still wasn't easy, and that process was a pain process for the servicer and the lender. Versus this process is not. They don't like it. Don't get me wrong. They'd much rather finance a new loan at 7% than keep a loan at 2.5%. But that's what we're dealing with. So when you enter or you get involved in these transactions, you do need to have some flexibility in your timeline for getting them closed.
Okay, good. Now, how can people reach you? How can they work with you? Understand, you know, you provide the service. It's sort of like an intermediary to help these things get through correctly and quickly. What's the process for working with? How does that work? You know? Yeah.
So our company is Assumption Solutions. Our website, assumptionsolutions.com. Email info@assumptionsolutions.com. You can reach out to us direct there. On our website, we have great sections for realtors, buyers, and sellers that talk about the process depending on who you are on the flow. We do like to connect with a seller and a realtor when they list a property, if possible. We engage the seller and we get what's required that allows us to communicate with their servicer. And we love to prep the servicer that this might be a thing. Because when you market a property that's got this, you may get just a regular person who doesn't want to assume that loan. And then we're not involved. But if you do get someone and we're ahead of the game, that's good. Then when you get that buyer, we connect with the buyer, we engage with the buyer, we vet the buyer through a soft pull credit check that doesn't hit their credit score. And we kind of are able to determine, are they likely to meet the qualifications? Then both parties have, through a secure portal, uploaded everything we need for the package. And we deal direct with the servicer to do it. We collect at a successful closing and not before a $475 fee from each party, and that's it. That's the process in a nutshell for us. So, and we just love helping people in this real estate market do something that saves buyers hundreds of dollars a month, something that helps sellers sell faster, possibly for more money, and get them on down the road to their next piece of real estate in their life. So
yeah, well, that's a great vision and a really big why, and it affects every. If you think about it, there's like 142 million households in the country right now, 330 million people, 442 million households. That's a lot, and this, the way the market is changing, this is going to become a lot more relevant and important. So it's a great service, definitely reasonable for what you're asking there. That's a no-brainer. I mean,
we think so too.
Yeah. Oh my gosh. I mean, you think about the impact, it's pretty tremendous. So I want to thank you, Craig, for doing this. Everybody listening, this is Craig O'Boyle. Okay. And how about the website again, Craig?
AssumptionSolutions.com. We have great training material there. We have downloadable material for realtors. We have info on the best practices for marketing these properties. And we're always open to chat with anybody that we can help who's got more questions or needs their hand sort of held through the process. That's what we're here for.
Well, that's awesome. And I also understand we're going to have you teach one of our Monday Night Live classes. Is that right? Coming up in I think in the winter months? Yeah.
January 30th. We're set to join you there. So looking forward to it.
Well, I'm looking forward to it too. And for all the agents out there and all the consumers too, you're welcome to join. Monday Night Live is an open class. It's free to the public, mostly agents, of course. Just go to the website, go to globalinvestoragent.com. There should be a link there for registering for Monday Night Live. And make sure you're there on January 30th. That Craig's going to be in teaching mode again. And that one's more interactive because it's not one directional. This is a podcast. That's going to be a class where you can participate with Craig. So I highly recommend you be on that one. And while you're out there, by the way, registering, please leave a review, a good review, because this has been a really good podcast for you, particularly the agents. And your reviews are what makes the podcast world go around. That's the currency of podcasts. So we appreciate you doing that. AssumptionSolutions.com, go to get information there. And before you leave, go to Global Investor Agent, click on Learn More, and join the community, especially if you're an agent. This is not the time to panic. This is the time to prepare, and we're going to help you do that. So everybody take care of yourselves. God bless you and your families, and we'll see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.